Welcome to a special edition of SB Talks. Today is Tuesday, December 17th, and I am joined, as ever, by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, Nick and I will be chatting today about our annual review and outlook report, looking back at 2024 and into the year ahead. Welcome to all our listeners. Looking back at 2024, Nick, it was, dare I say, a more positive year than we possibly could have hoped for across many metrics.
Yeah, it was a very strong year, particularly the US. So the US economy surprised many. This time last year we were talking about recession still, the possibility of a hard landing. A lot of economists were still projecting fairly soft growth. And quite a percentage were expecting a recession. They talked about monetary policy and the lags of monetary policy and how that had usually triggered a recession. That wasn't our view 12 months ago. So it was a much stronger year, particularly for the US economy, and that fed through to markets. So when we think about global financial markets, we had a second year in a row where the MSCI World Equity Index did above 20%. So through to the end of November, on an unhedged basis, the global equity index is up 28%. And that follows 23% in calendar 2023.
Stellar year by many measures. We'll come to the outlook for 2025 later on. And work out whether you think that there can be a third year of even positive returns after two very strong years such as that.
Yeah, I mean, it wasn't just equities. We also had a strong year for infrastructure, for high-yield bonds. So pretty much across the board, really because the US economy was strong. We had a lot of tailwinds. There was, as I said, there was no recession. US growth was stronger than expected. Real incomes were improving, so that means that people's salaries were now sort of exceeding the rate of inflation. So salary growth was exceeding the inflation rate, so people's purchasing power has been improving. We've had obviously quite a lot of fiscal stimulus still in the US. They've got a 6.5% budget deficit as a percentage of GDP. In Australia, we've had some sort of fiscal largesse in the form of state and federal government spending. So there's been a lot of sort of tailwinds. There's also been falling interest rates in many parts of the world, and unemployment has stayed pretty low. So there's not a lot to get worried about.
So it's the Goldilocks outcome to a degree, or dare I say it's almost too hot for the Goldilocks outcome. We've had those rate rises, and we'll come and we'll talk to the rate cuts, but the economies just show, the US in particular, such incredible resilience, exceptionalism throughout the year.
Yeah, some people are saying it's reverse Goldilocks. So a Goldilocks economy is an economy that's neither too hot nor too cold, as the fable talks about. But what we've really had is we've had a scenario where inflation has been coming down and growth has been going up. So that's sort of the reverse of Goldilocks, So it's been a strong year. The US economy, we thought it would grow at around trend of around 1.8%. It's actually on track to grow sort of in the high twos, around 2.7, 2.8% for this year. So, yeah, US exceptionalism, something we've been talking about for a long time.
And maybe quickly touch on inflation, because if we were recording here 12 or certainly 18 months ago, inflation was the big fear. How much it would linger. We've talked a bit on the podcast over the course of the year where it's sort of begun to trend down, but still sticky in patches, particularly across service sector.
Yeah, so, I mean, depending on which economy you're talking about, it has been a little bit sticky, particularly in the last few months in the US. So, core CPI in the US has been around that 0.3% for the last 4 months in a row. So there's some evidence that last mile of inflation is harder to kind of bridge, to get to the 2% target that the Fed is seeking. In Australia, inflation has also been quite slow to come down, and that's really what's kept the RBA on hold all of this year. But in Europe, inflation has actually been falling reasonably quickly. So it really varies by market.
Probably a bit more economic weakness there as well.
But I would say the markets have kind of moved on from the inflation story. That I mean, they do know that there will be some bumps in the road to get to that sort of 2% target or 2.5% in Australia. But I think that there's a general degree of confidence that we're heading there. It might just take another year to kind of finally kind of get there.
Now, as you write in your annual report and you mark your own scorecard, how good did you go when we reflect back and when we recorded and you wrote 12 months ago? What are you giving yourself a tick for? And is there anything that you put a line through?
Yeah, I have to say we got most things right. I think we were correct in saying that inflation would come down, which it did. That there would be modest rate cuts. Now, this time last year, the market was baking in, I think, 6 or 7 rate cuts for 2024. We didn't get those. We didn't think those would come, so we said modest. We've had 3 rate cuts in the US and probably at the end of this week another one. So pretty much in line with what we thought. We said there'd be no recession. We said a soft landing. Well, in some places there was no landing. In Australia, we're probably a bit closer to the mark. We thought, growth here would still be pretty sluggish, which it has been.
Definitely, particularly in per capita terms.
Exactly. We were correct in saying that we thought the Magnificent Seven, the 7 largest sort of tech stocks in the US, would continue to probably outperform the rest of the market, which they have for most of this year. We thought that the US economy, the US equity market would be the sort of outperformer, which it has, and growth stocks. So we got those things right. We said investment grade and high yield bonds should have a pretty good year, that global fixed income would outperform Australian fixed income, given our view on where rates would go this year, and that has been the case. And we said that we thought within the infrastructure, listed infrastructure space, sort of energy infrastructure would do better than sort of more GDP cyclical infrastructure, which has been the case. So largely correct on all of those things. Where we got it wrong, as I mentioned, we underestimated how strong the US economy would be, and we underestimated how strong the equity market would be. So we thought earnings would grow globally by in the high sort of single digits, which they have. And that the US sort of, or the global equity returns would sort of be in a similar, high single digit kind of range. But obviously at 28% year to date, we completely underestimated how much valuation multiples would expand. So they were expensive a year ago. They're now arguably more expensive as we sit here today.
Particularly in certain sectors of the concentration in the market, which we'll talk to a little bit more there. As we look back again in 2024, now we probably have to turn our eyes and you, as you think about how you position portfolios, maybe we could start to explore what some of your key views are on the outlook for 2025 and the year to come. Fair to say that we're not going to hope or expect a 20% plus from equities, but how much caution do you have on the outlook, given that sort of back-to-back years of 20% plus returns?
Well, let's park the equity market returns to one side and look at the underlying economy, and there's a lot to like. Now, let's assume that there isn't a major global trade war, because I think that will upset the apple cart and potentially disrupt, particularly Europe and China and potentially Canada and Mexico and some places like that. But parking that to one side, if we look at where the economy is today, I mean, you still have to be pretty optimistic about the US economy for the next 12 months. Some of the things I mentioned, with low unemployment, with inflation kind of gradually coming down, with potential for further interest rate cuts, although maybe as they're fewer given the strength of the economy, real income improvements, Donald Trump potentially putting through some tax cuts next year. It could be another fairly solid year for the US economy. For Europe, assuming that there's no trade war, things should continue to improve. Their rates are coming down, real incomes are improving. They've got some issues around sort of fiscal consolidation, but broadly, no one really wants to tighten their belts over in Europe. So I think, it's reasonably positive for the global economy. And China, well, we know China's got some issues, but, there's been quite a lot of announcements for stimulus there and potentially more to come. So I think you have to
Do you feel they'll be able to change their trend? It's been sort of a tough, probably 12, 18 months there.
I think there's a few levers they can pull that maybe, put a bit more of a floor under the property market and the equity market. Can they change sort of consumer behaviour? I think there's a bigger question mark about that. Consumers are still very reluctant to spend. There's more savings going on. Unemployment, particularly youth unemployment, is still quite high. So I think there's some structural problems, but the government can pull a few levers to potentially just boost growth a little bit in the sort of the next 12 months to kind of keep it around that 5% target that they've been seeking.
And how does that shape then your thinking for investment markets and how positioning portfolios?
So I think, that's a scenario that should be generally good for investment markets. Now, as we discussed, valuations, particularly in the US and Australia, are quite high. So I would be very surprised to see further earnings multiple expansion. Investor sentiment's actually quite bullish at the moment. So, once again, that's a bit of probably creates a little bit of a speed limit. But then you talk about things like US deregulation, particularly in areas like the financial sector, in the energy sector. You potentially have more mergers and acquisitions activity and IPO activity, corporate buybacks. So there's some other tailwinds that are potentially coming through that could support the equity market. And there's a lot of money that's been flowing out of cash into equities. There's sort of a bit of a FOMO effect. Now, we've seen this before in 2021 when the market kind of peaked previously.
And we know how 2022 started.
But that was all rate driven, remember. Largely that was the shock.
That was the back to reality of interest rates again. And then we had obviously the Ukrainian crisis sort of lumped on top of that.
Yeah. And the other thing to just kind of bear in mind, there is precedent for more than 2 years in a row of 20% US equity returns. So at the end of the 1990s, heading into the dot-com boom, we had 4 years in a row. If Trump cuts taxes from 21% to 15% for companies, that could potentially be a bit more of an upside. So, look, it's not out of the realm of possibilities that you could get a third year in a row of sort of 20% plus returns, but that's not our base case. Our base case is probably more, that sort of high single digit, low double digit type returns.
Which are, I guess, long-term trend and enough to give you confidence to remain invested.
Yeah, and that's based on the earnings outlook. So, if you've got solid earnings growth, solid economic growth, inflation coming down, rates coming down, potentially some of those cost pressures abating, corporate margins should stay pretty high, and that should translate into reasonably good earnings growth as we've seen in 2024.
Now you've talked there about a few caveats. You talk about the outlook, but there are definitely a few overlays that could influence things. Perhaps we could talk about some of the key themes that might be shaping the year ahead. And one of them you've talked to, the 47th President of the United States, Trump, term 2.0, the potential for positives of lower taxes, deregulation, but also this big uncertainty of just how far they go on tariffs. How do you think about that?
Yeah, so I think, there's a wide range of outcomes. I think, Donald Trump thrives on being unpredictable, so we really just have to wait and see, what actually happens. Certainly there's been a few tweets about what he might do to Mexico and Canada and China and potentially some of these other countries that are exploring moving away from the US dollar for trade. So there's been a lot of threats thrown around. We know markets don't like uncertainty. They don't like economic uncertainty. CEOs don't like economic uncertainty.
Hard to invest in an uncertain environment.
It is hard to invest in that environment. And we saw some of that in 2018, 2019 with the previous Trump administration and the tariffs that came with that. So I think there's a lot of wide range of outcomes. Our base case is that there'll probably be more tariffs on China. There'll probably be tariffs on European cars. That he won't follow through with a 10% universal tariff on everyone. That would be quite disruptive. So I think we just have to wait and see. But the way markets are sort of thinking at the moment is a lot of these things are just idle threats and part of his art of the deal negotiating tactics.
So we'll not pre-position for those threats necessarily yet, but watch how they unfold. One of the other key things over the last 24 months has certainly been artificial intelligence. And how do you think about the influence that might have on economies and on markets?
Yeah, I'm spending a fair bit of time kind of looking at all of this. I think there's some things to like about it, and there's some things to be a bit concerned about. So on the one hand, there are some, I talk about in the report, there's potentially, AI is a solution looking for a problem. It's not necessarily the killer app that, say, the personal computer or the internet was, which really had, an ability to lower costs for a lot of companies and consumers. So I think there's that. There's some evidence that companies like Google are spending big on AI more as a defensive move to protect their search engine revenues.
Protect their market share, dare I say, monopoly position.
So I think you need to kind of look at that. There's there's obviously a lot of hype, but AI still has a lot of issues with hallucination. There's now a shortage of data that can be used for training AI models. We've basically scraped the world's internet, so there's not a lot of new data that we can train with these models. So, does that mean they can't necessarily progress a lot further than where they are today? There's some potential for commoditization. We've seen prices of AI bots, kind of come down quite aggressively as all these companies compete.
And we've seen companies like Meta go open source with the work that they're doing to try and level the playing field. Yeah.
And there's a website called Hugging Face where there's 900,000 open source free models to download.
Wow. Okay.
So there's a lot of free versions of a lot of these
Dare I summarize
models.
for you there that you're sort of setting a picture where you're sort of a tad, I guess, curious, but not overly exuberant about the impact that it's going to immediately have.
Yeah. But I think, with a lot of these things, over the long term, yes, it will actually be a bit of a game changer. I just think it won't necessarily happen this year or next year. And that happened with things like PCs and even the internet. There was a lot of hype, in the .com,
Fun uses rather than practical uses.
That's right. And the companies that were kind of well rated were the Ciscos of the world, which provided routers, but they weren't the ultimate winners. The ultimate winners were people like Google and Meta that were able to then capitalize on it, years later. So I think, maybe there's an element of that. I'm optimistic about it, but I don't think it's going to be necessarily something that moves the needle in the next few years.
Makes sense. Related to that, we know the big story over the last probably 4 years and certainly the last couple of years has been the technology space, and AI has been one of the factors that's been driving the exuberance there. But the market has become, the US market, I should say in particular, has become incredibly concentrated around a few names who are trading on fantastic valuation multiples and now have a lot of pressure to deliver.
I think, obviously concentration, has some people concerned. They think it, potentially adds more risk to the market, particularly, if you've got companies that maybe are on unsustainable valuations. But what I talk about in the paper is that concentration isn't necessarily a problem per se. Take the Australian market, for example. Our top 10 stocks are 47% of the ASX 300 index. The 10 or 11 largest companies in Europe are a quarter of their index. In South Korea and Taiwan, one stock is 20% of their index, Samsung and TSMC respectively. Even the Japanese market is on some measures quite concentrated. So concentration is something we've seen in a lot of markets and even in the US at different times in history. But the reality is, trees don't grow to the sky. It gets harder for larger companies to continue growing at, very high growth rates. And so I think that's what you need to kind of keep in mind. So I think, the issue is, are they overvalued? Well, arguably some of the Mag 7 are, but some of them aren't, necessarily relative to the kind of earnings growth that they've been generating in the recent history.
I guess if they come back to the pack, a part of the question is, does the pack catch up or do they come back?
Well, I've written about this before. I call it the catch up, where the pack catches up, or the catch down, where the Mag 7 kind of, moves back down towards the pack. And I think there's probably a little bit of both.
Room for a bit of both.
For a bit of both.
And again, we're not saying that the Mag 7 don't all move uniformly by any stretch of the imagination either. Yeah.
So I think market concentration is something worth monitoring, but not necessarily something to be overly concerned about at the moment. Yeah.
And we continue to have geopolitics as a bit of a theme / threat in terms of world position. We know the Ukrainian conflict continues, unfortunately, continued escalation and retaliation in the Middle East. China sort of hovers on the horizon as a potential issue, and we've obviously got Trump's rhetoric thrown in on top of that. Always hard to position a portfolio around that, but how do you think about it in terms of how you look into 2025?
Well, I sort of look at it, as this sort of grand move towards a multipolar world, where the US maybe becomes a bit more inward looking, and then you've got the sort of the countries, autocracies of Russia and Iran and China and North Korea and, those countries kind of forming this cooperative alliance, So I think this is part of a broader trend, which is also to some extent tied in with the trade wars and the reshoring of production back to friendly countries. And, so I think it's part of a broader trend. Am I worried that there could be something next year? Well, there's always the risk of an accident, but I'm not sure that there's anything major. The one thing that I do call out is I do think there's a reasonably high chance that the Trump administration may try and take out Iran's nuclear facilities. Right. So Iran has been enriching uranium. They've got to 60% enriched uranium. It only take them about a week to turn that into weapons-grade uranium, and apparently they would be able to construct 5 nuclear weapons. So I think, the current situation in the Middle East is one where I think there would be a reasonable chance that Trump might try and take those out.
And we know from his prior administration that he was pretty keen to roll back on any deals with Iran and not really to allow them to advance that. And he's very clearly, strongly in support of Israel in terms of his positioning there. So if that was to occur, what would be your concerns in terms of some of the flow-on implications?
I just think that would be maybe something that markets hadn't really been focused on. Obviously, Trump's, taken a hard line with Iran. It didn't work in stopping them, progressing their weapons program. I think, that could give the market a bit of a shock. I mean, there was a bit of a hint of that when Israel went in a few weeks ago, and there was some worries that they might try and take out the oil facilities or the nuclear facilities then. So I think that just could be, give the market a little bit of a jitter. Maybe not. Maybe it would just, get over it like so often has been the case.
I guess it often depends on what's the next stage response and other players potentially getting involved in the escalation is probably the key fear around that.
But given how quickly the Assad regime in Syria fell, and Iran and Russia were really unable to contribute much to that maybe it's a good opportunity for the Americans to
Well,
to
potentially
take
they
this
look at
move.
that and think, that happens overnight.
Yeah.
Obviously, question marks over what comes next there. Any other themes? Anything else that sort of shapes your thinking as we look ahead?
The other theme I talk about is this whole democratization of alternative investments and private markets, something that we've seen in the past few years, and I think that that's something that's going to continue where, this sort of split between investors, really getting a bit disappointed with active fund management and going into the passive, into index type investments, but also at the same time, maybe also putting some more money into these private markets where they perceive that there's higher potential returns, lower risk, lower price volatility, more diversification.
So how do you think about the opportunity set in the alternative space?
I think we need to be cautious. Whenever big fund managers decided, well, we can't get any money out of our institutional clients anymore, we'll go down into affluent and retail clients. I think there's always a reason to be a little bit skeptical as to why they're doing that and what the risks might be. And for me, the biggest risk is what you get is too much dumb money or hot money. That hasn't necessarily done the due diligence and doesn't necessarily understand some of the risks. And a lot of these products are dressed up to look like a traditional managed fund, open-ended managed fund. But if something were to, if there were to be a downturn or a scare, it's a bit like a bank run. Everyone heads for the exit at the same time. And I think that's something that we just need to be aware of.
Well, I guess you have to do your due diligence and you've got to invest with your eyes open, understanding if you are owning private market assets that aren't easily traded, then you should expect if there's a period of economic challenges that it's going to take you longer to get your funds back. I'd say we have certainly seen in some areas an absolute proliferation of managers pop up. The private credit space is the one that most comes to mind. And I think that's one where we say, all managers are definitely not equal. All strategies are definitely not equal in this space. And it's one where you really want to do your homework.
Yeah. I mean, we've even seen it in real estate. A lot of real estate funds, that had been very popular for many years have also sort of suffered from the perception that the returns were going to be negative and people headed for the exit and they've locked up. So, but you're right. Private credit, it seems to be the hot asset class at the moment.
AI and private credit, topics du jour. I guess, do your due diligence, potentially certainly worthy of investment, but go in with your eyes wide open and talk to your financial advisor, dare I say.
Yeah, absolutely.
On that beautiful note, I want to thank you very much, Nick, for your many interesting insights over the course of 2024. I want to thank all our listeners. I want to wish you all a wonderful Christmas period, and we look forward to doing it all again next year. Take care and have a great break.
Take care.